Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
All right, everyone. Welcome to another episode of The Financially Free Investor. Today, I wanted to bring you a little bit of a case study. This is on a property that I personally purchased a few years ago. I thought this would be a super critical episode to the podcast because this was one of my first properties I bought. So let's see, it's actually the third investment property I ever purchased. I purchased it, just a little backstory. I had actually purchased another house a few months before this one. We bought it at a foreclosure auction right down the street from this particular house that we're going to talk about. So I had kind of already known the values of, call it a 1,900 square foot, 4-bed, 2-bath house in this area. We bought this in 2018. It's a 4-bed, 2-bath. It did not have a garage. We found it from a wholesaler. So if you're unfamiliar with what a wholesaler is, wholesalers typically don't have a ton of money, but they want to be investing in real estate. What they'll do is they'll go out and they'll find motivated sellers. A lot of the times if you're driving and you see a We Buy Houses sign or we pay cash for houses in any condition, that kind of a thing, people will go and put these signs out and then get motivated seller leads. And they'll go and they'll offer them a certain price for the house and they'll take that contract and then they'll go and sell it to an end investor who either wants to flip it or hold it as a rental. We found a wholesaler. They emailed us this deal. We went and took a look at it. I was like, okay, cool. We bought it with a hard money loan for $225,000, which at the time I was a little nervous on that price. However, I knew that, with a little bit of elbow grease, and truly it was a little bit of elbow grease, we sent our handyman in and fixed a bunch of the paint issues and just made sure it was safe, fixed some electrical stuff, tuned up the furnace, changed locks, little minimal stuff like that. We knew that this house was worth somewhere between $280,000 and $300,000. And the problem with this house, it was right next to a major freeway, and the margin wasn't big enough for most people who wanted to flip it, because by the time you pay a hard money lender and you pay realtor fees and rehab and closing costs, it just didn't make sense. There wasn't any money in it for a flipper. So we came in, we were able to pick it up with a hard money or a bridge loan, which is really just a fancy way of saying it's a temporary loan. We went to another investor who had the cash and said, hey, we'd like to purchase this, and our plan is we're going to fix up the little issues that need to be fixed up to get it rent ready, and we're going to refinance it and stick a renter in there. Well, my particular hard money lender on this actually happens to be a long-term lender as well, so he lent us the money. We bought it. We closed 3 days later, which kind of get into these deals is, you can find a deal, but you need to close within usually a week, and you have to put up a bunch of non-refundable earnest money, and there's just not a lot of ways out of the contract versus, maybe a retail deal where you get a due diligence period. You're able to go through and get a home inspection. We were buying it at such a deep discount that I figured, hey, even if there's a few thousand more dollars worth of stuff that I'm not seeing, we can get it fixed because of how well we're buying it. So the person that was selling it was just in a hurry. We went in, rehabbed it, got it kind of rent ready. We had it rented pretty much out the gate for $1,595 a month. Our full payment, PITI, which is principal, interest, taxes, and insurance, was $1,450 a month. So our cash flow was pretty slim on this deal. And this was right, like I said, at the beginning of our journey that we're on right now to financial freedom. And I was like, hey, this is cool. We were into the deal for about $3,000, $4,000, more or less. Way better than me going and putting down 20% on a $300,000 house. That would have been $60,000 or $70,000. And we were able to get into this deal for less than $5,000. So I was like, hey, I'm cool with it. The cash flow being slim. Rates were a little bit higher at the time. We refinanced out of the hard money loan, went from 12% interest to 5.5% interest. Our cash flow, more or less, with me managing it, was roughly $150 a month, just enough to cover if there was a weird drain issue or, electrical issue. Luckily, we didn't have any of those issues for the first year, so we kind of just let that cash flow build up into a reserve account. So, 18 months later, we had enough money to make a payment or two if the tenant left. Anyways, when we were refinancing it, I met with the appraiser, and as far as he was concerned, he didn't know how much I paid. It was an off-market transaction. I had kind of a handful of comparable properties, and I met with him, and I said, hey, I'm not telling you how to do your job. I just happened to have refinanced a property down the street a couple months ago, and this is where the value of that one came in. And This one's pretty comparable to that one. So I know you've probably already done your research, but just give you this data and see if it helps you at all. If not, no worries, totally cool. He was grateful. I'm not sure if he used it or not. It was all public data that he would have found anyway. So that's just a little tip there, right? If you're trying to hit a certain value, everyone sees the world a little bit differently. So sometimes it can be very beneficial when you're doing a BRRRR, which again stands for Buy, Rehab, Rent, Refinance, and Repeat. BRRRR is just the acronym. It's helpful to meet with the appraiser, and without telling him, hey, this is how you do your job, you're able to say, hey, look, this is kind of the data I found. I always kind of like to approach it like, hey, I'm not sure if this would be helpful, knowing full well that an appraiser knows how to do their job. It's just a little bit softer approach to trying to hit a value that, can be manipulated. There's a certain saying in real estate, if you have the same house in the same point of time and you have 5 different appraisers go and appraise that house, everything is subjective in real estate. And so, you can get 5 potential different values based off of investor, the life experience of that appraiser. So, what one house they feel may be comparable, another appraiser may disagree. So, sometimes it helps to hit refinance goals is if you can meet with the appraiser and build a little bit of rapport. And again, don't tell them how to do their job. Show them the data that you're seeing. Anyways, fast forward 18 months later, mid-2020, our tenant had moved out. And I contacted our property manager because we were a little bit further along in our investing journey. And the property manager I had managing everything else, I had actually handed something off to her. And, I was previously trying to rent that myself. So when I handed it off to her, she actually rented it for significantly more than I was trying to rent it for. And in essence, she paid for her own fee, which was really cool. When you work with professionals like that, a lot of the times they doing it all day long, they see things that you don't see, and they're able to optimize things that you don't even know about. So we handed it off to a property manager. They had re-rented it for $18.95 a month. And some point in time we had refinanced when rates had dipped and our payment was $1,200 a month. So we were now cash flowing and paying a property manager, so I wasn't having to deal with it, and it was actually making a pretty good chunk every month. Now fast forward to today, and we're selling it for just under $500,000, $450,000-ish. And this is the beauty of buy and hold real estate. Not only did the tenants pay down the mortgage a little bit, granted it's only been a few years, we didn't go the full 30 years or even 10 years on this one. However, market's hot. If the market does shift into maybe a buyer's market in the next few years, this is maybe the one property that I wouldn't love owning. Nothing wrong with it. It's a great house. Just kind of looking at everything, I said, hey, this one's got a ton of equity, and all things being equal, I'd love to move that equity into something a lot newer. This house was built in the 50s. Again, nothing wrong with houses built in the 50s. However, I'm looking at it going, hey, we could potentially take our equity and buy 2 properties that are both 1980s or newer. So just less problems, nicer neighborhoods, newer neighborhoods, better prospects for appreciation and rent growth in the future. Overall, this is the BRRRR strategy, right? All comes down to buying a property right. So finding a motivated seller, finding a good deal off market typically. Sometimes you can find them on market. Just really buying below market value. And then rehabbing it. And this can be as easy as painting, changing paint colors. We sold a property to another investor that all the walls were crazy colors, like bright green, bright yellow, bright blue. And he just went in, painted everything white, just all very vanilla. The comparable houses were selling for 10 to 12% more than what he paid. So he's able to walk in with some equity. With a little bit of legwork, really it's not that much. The power of BRRRR method in investing towards financial freedom is that you can get into properties for less money down than a 20% down payment. A couple things to consider though. This is not for the faint of heart. You definitely have to have more time available to find these kind of deals, and then to be able to take them down and rehab them and refinance them. You're essentially closing twice. A lot of different moving pieces in here. However, it's all dependent on how good of a deal you can find. Now, if you're someone that's making a ton of money in their job, maybe this isn't the right method for you, just because you can go and generate such a good revenue on an hourly basis that it means less for you to go and buy a deal like this versus just putting 20% down. And you'll notice that most of my money here was made in waiting. You stick a good renter in there, someone that's paying the mortgage with their paychecks every month. They need a place to live. So it's not a vacation house. And over time, the deal starts looking better and better and better, right? When I first bought this deal, it was mediocre at best. Like, it was great that I could get in for less than 20% down, but really didn't make that much money every month. And you fast forward a little bit, rents go up. I was able to take advantage of a time in the market where interest rates on mortgages went down, refinanced my rate down, which saved me a couple $100 in interest. And then all of a sudden it's cash flowing really well. And you look up 4 or 5 years later, and this one single family house made a huge impact. So if you just take anything away from this, buying one deal, even if it's thin right now, will make a big difference in the future. And again, even if we never had rent growth, if we never had the payment drop, this property would have paid itself off with a tenant, basically, or 20 tenants, whatever it took in 30 years to pay it off. So the most crucial thing to this method, guys, and I'm going to end on this so that, if anyone wants to go and do this, I'm happy to talk about it. Before you go out and buy a deal, talk to a lender that does regular mortgages and make sure that you can qualify for a normal 30-year fixed rate mortgage before you go out and buy a deal on a hard money loan. Because this can be disastrous if you buy a deal and it turns out to not be a deal, and then you turn out to not be able to qualify exactly. Maybe you have to fix some stuff on credit or pay some stuff off or what have you. And then you can be stuck in a 12% interest loan. It's short term, very costly, and all of a sudden, one deal can go from being great to being terrible. So that's it, guys. Please let me know what you thought in the comments. Shoot me an DM on social medias if this interests you and you want to learn more. All right, thanks. Thank you for joining me for another episode of The Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.